Hi, everyone, and welcome to this week's edition of Feeling Smarter. I'm joined, as always, by Tim Miller, our Head of Technical and Education. G'day, Tim. How are you?
Very well, Aaron. Yourself?
Not too bad, thank you. Well, we're going to continue on our journey of the proposed Div 296 tax. We are getting bombarded with questions from our members and from others that use our Smarter SMSF platform. So we want to keep on this journey as we unpack this proposed law. And today, Tim, we want to talk about the exclusions of when Div 296 is payable. And to me, this is really one of the interesting areas because the government has been hell-bent on this concept of, it's going to impact only 80,000 people, when the reality is it's going to affect a hell of a lot more than that when we start to look at the implications of an individual dying. So when we go through and look at who is liable for the tax, we have seen a number of exemptions here, and I'll get you to go into these, but first we'll focus on the death of a member.
Yeah, so there are a couple of exceptions, and the first primary exception that kicks in is that if a member dies before the last day of the financial year, then Div 296 will not apply to them. So the reality is, and certainly the reality inside self-managed superannuation funds, is often a member will pass away and their balance will still exist at the end of the year. But that balance will not be subject to the calculation of Div 296 tax. So let's be clear about that. But what happens with their benefit then becomes sort of more speculative and more strategic with regards to the way the legislation is going to be introduced. Now first off, there's a real simple further exclusion, and that is if their death benefit is utilised to pay an income stream to a child. So let's say they've got children under the age of 18, then those income streams will also be excluded from this Div 296 tax. So child recipients of account-based pensions on the death of a parent, as much as it's going to be unlikely that they'll have more than $3 million, will be excluded from this measure. But it does of course make for some interesting conversations around spouse-based funds.
Yeah, so one of the things here, as you touched on, the fact that we have an individual that has died before that last day of the year, we don't look to include that. But as we spoke about in our last edition as well, when we looked at our calculation of net earnings, we actually have the fact that the beneficiary here would have that amount added back as a contribution. So again, we've got our kind of debits and credits that I spoke about with our transfer balance account. In essence, we get that benefit in year one of it, the amount not being included for the beneficiary that is becoming entitled to receive that money. And that really then opens up the conversation about reversionary and non-reversionary pensions, doesn't it?
Yeah, it does, because as we know, the transfer balance cap is a totally separate issue, but as far as a benefit, as far as beneficiaries are concerned, your entitlement to that income stream starts the day that the member passes away from a reversionary point of view. And we always have known that from a total super balance point of view, your total super balance is impacted from the day that the pension commences. So with a reversionary pension commencing on the day, effectively for the day of death, then the credit that you'll get, so the exclusion of your contributions for the surviving spouse, will occur in year one. But if you have a non-reversionary pension, or more a discretionary death benefit income stream, then the timing of the commencement of that is going to be pretty critical, because if we're talking about a member passing away late in a financial year, then it would make sense from a $3 million balance point of view to hold off from the commencement of a new death benefit income stream for the surviving spouse to the following year, because then in the following 30 June, they will get the credit effectively, or the debit. You know how great I am with accounting terminology there. They will get the removal of the contribution in that following year.
Yeah, and that's going to make a fairly substantial difference as to the timing of when that individual dies. So yes, there are some considerations around that reversionary and non-reversionary concept, but ultimately that would come down to, well, if the individual died in May, well then, yes, it's going to be beneficial for them to effectively defer the commencement of that death benefit income stream until, say, 1 July, because that credit won't get added back until that following year, versus if they actually had it as an auto reversionary, well, then it ceases upon death and the starting day becomes relevant for that individual. And that obviously goes back to our TR 2013-5 views expressed by the ATO. But if we take it to September, well, in a typical, couples situation where it needs to be done as soon as practicable, we're going to end up in a situation whereby it's probably not going to have any major difference between one and the other. No. But in saying that, if we don't know, that is the unknown. We don't know when someone's going to die.
That's right.
So therefore, it does naturally raise that flag on the non-reversionary side, maybe rather than the reversionary.
Yeah, correct. Absolutely. And that sort of leads into, and that child pension issue that I raised before sort of leads into the second exclusion, which of course occurs generally before death, and that is that there's an exclusion for our structured settlement recipient members. So those that are in receipt of a structured settlement payment into super, we know that they're excluded for a lot of reasons, for transfer balance cap purposes, for total superannuation balance purposes, and that's going to flow through to Div 296. Now, one of the quirky elements of the legislation, and one of the things through consultation that we were really keen on, and now that the consultation period's closed for this bill's introduction, it'll be interesting to see if there is any further changes. But one of the concepts that we've been fairly hot on is total and permanent disablement. Now, we know that there is an exclusion to the crediting of insurance proceeds in year one when you receive an insurance benefit, but then following that, you don't get any further exclusions. Now, again, when we talk about structured settlement versus total and permanent incapacity, they're ultimately there to provide for the same thing, which is to provide for a certain standard of living. And if that insurance proceed is going to kick you up into a higher tax bracket, then again, there's some real inequity with the way this legislation's been drafted.
Yeah, and hence why we obviously have been demanding a little bit more time to consult and go through, but sometimes government just doesn't want to listen. So
that's right.
Well, on that note, thank you once again, Tim. We'll be doing a lot more work around these proposed rules. We'll be putting together some specific training in more detail, but we do have, of course, our SMSF masterclass where we are talking about the topic of contributions, and some of this will be naturally relevant to that masterclass. So I encourage you, if you are not a member, to go on to our site, smartersmsf.com/events. You can register for that upcoming masterclass, or naturally think about becoming a member, which it is included as part of that subscription. So Tim, thanks again for joining us for today's edition of Feeling Smarter.
No worries, Aaron. Look forward to speaking to you next week.
All right, take care. Bye for now.
Bye.